Good morning, everyone, and welcome to Choosing a Retirement Plan for Your Business. I'm Vinny Civitello, Communications Manager for the New Jersey Business and Industry Association. With us today is Kai Chen, a financial advisor and certified retirement plan specialist with Morgan Stanley. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow, along with the PowerPoint for today's presentation, so be on the lookout for those. I'd also like to draw your attention to the Questions tab. Kai would be happy to take all of your questions, so don't hesitate to write them in as they come to you. And I can't stress that enough. Be sure to type them in as they come to you, or you may forget what you wanted to know by the time we come to the Q&A. So now let's get things started. Kai?
So good morning, everyone. First of all, I want to say thank you for your time. I know you're all very busy business owners. Appreciate your time. So secondly, I want to say thank you to NJIA, particularly Vinny, she's the technical support for today's webinar. Not only for the webinar, but also for many activities that NJIA have been doing for the New Jersey businesses. Thirdly, I want to say thank you to my partner. Her name is Zhihua Liu. She's from Penserve, a pension consulting company. Zhihua has many years of experience designing retirement plans and also a third-party administration for the retirement plans. Lastly, I would like to introduce myself a little bit. My name is Kai Chen. I work with Morgan Stanley. I'm a certified chartered retirement plan specialist. I'm also qualified plan financial consultant. The new we call it is a certified plan fiduciary advisor. So I had a passion on retirement plans, particularly retirement plan for the business owners. I have been a business owner by myself. I've been serving business owners for the past 5 years. My observations, the business owners, particularly on retirement plans for business owners, was undereducated and was underserved. So that's my goal for today, is to educate you on the benefit of the retirement plan and what's available to you and what you should consider when you select a business plan. So let's start. It's not going. Slide. Hold on one second. I'm trying to figure out how to move the slide. Okay, so the next slide we had a long list of the day-to-day business challenges you might have. I believe if I ask every single person, you will have a much more longer list than this. So what I want you to do today is to add one more to here, which is the retirement plans. I think retirement plans can do not only for save yourself and your family something for the future, it's a retirement plan too, but also it's good to attract key employees and to incentive to have the loyalty to your company. It's also definitely also lastly, the retirement plan have some tax benefit. So why it's important to prepare retirement early and in a tax deferred vehicle like retirement plans. So there's 1, 2, 3, that's 5 reasons here. The first one is a longer life. So we basically live longer than before. Because on the way to be here today, I talked with Zhihua. So we right now very common. Well, friends and relatives, you see neighbors that's 80s, 90s, even more than 100. So if you still retire at age of 65, you have 30 years, 40 years to live on the retirement. So that's longer life of retirement life. So we need to prepare more than what we used to prepare. We can rely on Social Security, but however, Social Security, we talk about the bankruptcy of Social Security and the founding of Social Security. No matter what, Social Security was designed to be a supplemental income, not a major income for the retirement. Inflation, so inflation basically we need to prepare more because if inflation, the every healthcare cost, college cost, every daily life cost would be higher by the time we retire. It's provide a valuable employee benefit. So health benefit, retirement benefit, so they are part of the employee benefit. Tax advantage. So I'm not a tax consultant, but a retirement plan do provide a tax benefit for the business. So on the next few slides, would like to use some numbers to explain why it's important to save in a tax-deferred vehicle and to save as early as possible. So for the first slide, is as a person who saved for 40 years. Every month, saving $100 per month. We assume it grew at 6%, and this person in the 25% tax bracket. I believe a lot of person pay much higher than 25%. So on the blue color, there's the white. And on the white one is the person who saved in a taxable vehicle, regular income. So after 40 years, every month $100 would grow to around $100,000. However, if we look at the blue column, so the same savings, $100 per month, will grow to almost $200,000. So if we do take this out at same immediately pay 25% tax, that still come to almost $150,000. So I heard this a lot because some people say, hey, you could save some tax now, but eventually you still need to pay tax. Why bother? So this tells you the difference of the tax deferred vehicle and the taxable vehicle. So it's almost 50%, even if you only save $100 per month. The next slide is talk about the power of compounding. So it's you save at the earlier the better. So two persons, Steve and Diana. Steve start to save at age 25, and Diana start to save at age of 35. So the difference is 10 years. That's about $12,000 for those 10 years contributions. However, on the end, you see still the white one is Diana, the blue one Steve. So Diana only accumulated about $100,000. The Steve accumulated almost double, so the $199,000. So it's important to start to save as early as possible. So because the money could grow. There's many retirement plans are available on the market right now. So we're going to cover 8 here. Besides that, I will also talk a little bit about the ESOP. It's not on the list, but however, recently I see a news from CNBC. So basically, ESOP is a tool. Retirement tool is also a tool to give employee some shares of the company. So it's a great incentive to keep the key employees. So let's start. Before we go to details of every retirement plans, so I would like to introduce a concept called qualified defined contribution plans. Here, there really are 2 terms. The first term is qualified plans. The second term is defined contribution plans. So qualified plans, 401k is qualified plans. Profit sharing is qualified plans. SEP IA is not qualified plans. The qualified plans, you basically need to meet a higher requirement with the government. However, it also have the benefit. It's better credit protections. You also need to have the trigger event to distribute money from the qualified plans. The defined contribution plans, comparing to the old traditional defined benefit or the pension plans, defined contributions, we know how much we put in, but we don't know how much we really retired, what's the benefit, how much we can get out. It depends on how you manage and how those money was grown. So majority of the retirement plans on the former list are defined contribution plans. Beside the last one is the defined benefit plans. Let's go back to, there are some common basic features of qualified defined contribution retirement plans. So no matter which plan you have, 401k or profit sharing or safe harbor 401k, money purchase, you all have this eligibility, vesting, distributions, loans, filing, and plan fiduciaries. They all have these features, common features. So eligibilities. So not every employee are eligible to get the employee benefit like retirement plans. So you have some flexibilities. Of course, there's also some rules and regulations. Usually it's age of 21 and 1 year of service. So vesting. So the employer portion of employee contributions, you must have to be always 100% vested. But the employer, meaning as the owner, what you put into the retirement plan for employees could have a vesting schedule. Example of a 3-year cliff vesting, if the employee only work for 2 years and he's go to different companies, he will not entitled to the retirement plans you put out to him. But if he worked for 3 years, he get 100% of all those retirement plans money you gave to him. So the distributions, that's one of the qualified plans difference from the non-qualified plans. If you had IRA, you could say, hey, I want to take the money out, I would pay penalty and pay tax. However, for a qualified plan like 401k, it's not work like that. You have to have a trigger event to take the money out. So those events, examples of death, disability, go to different company, so separation from service, or the plan was terminated, or some hardship withdrawal, so some requirement for the in-service withdrawals. The loans, qualified plans, it's possible to borrow from the qualified plans, but it's not possible to borrow from IA and SEP-IA. Filing requirement, majority of the qualified retirement plans, you need to file a 5500 form. So that was filed actually, Zhihua is usually help the company to file 5500 form. Lastly, last feature is plan fiduciaries. So as a business owner, so you are a plan sponsor. Most likely you're also a plan trustee. So you are one of the plan fiduciaries. So as a plan fiduciary, you behave on the best interest of the participant. So you're responsible for determining how plan assets are to be invested or other discretionary functions. To limit potential liability you could limit potential fiduciary liability by retaining an investment manager or investment advisor. However, as a plan fiduciary, as a plan sponsor, you remain responsible for assuring that the investment manager selected or the investment options offered to the participant has a prudent process and remain a prudent process. So that's the plan fiduciaries. Now we go to different plans. We start from profit sharing plans. The most important feature of the profit sharing plan is one word: flexibility. So on a good year, you could contribute a maximum. Every individual is $54,000 for 2017. On a bad year, you could also choose not to contribute. I would also like to add, for profit sharing plan, you don't really need to have a profit to contribute. So that's some of the good candidate for profit sharing plan is variable profit pattern and has seasonal employees. Money purchase pension plan, this is not popular at this time. We might still have some legacy, but for the new plan, not too many, so we would ignore this. So next will be 401k plan and a safe harbor 401k plan. The 401k plan is the most popular plan among the U.S. businesses. So if you work for a big corporation, chances are you would have a 401k plan. So myself, I will work for a big bank, so I had a 401k plan. Work like this. So me as employee, so I could select to contribute to deduct some portion of my salary to be in 401k. On a dollar-to-dollar basis, my employer, a big bank, would contribute, would match my contributions, but that's maximum. So my company matches 5%, but there's some other company match 3%. Also know a company to match 8%. So that's flexible. That's by design. However, the 401k, you need to have a filing requirement, 5,500. Also, there's ACP and ADP testing. Many small businesses would like to avoid this ACP and ADP testing, so they use a safe harbor 401k. Safe harbor 401k is the most popular among small businesses. Safe harbor 401k automatically pass ADP and ACP test. To pass that test, go to safe harbor 401k. The sponsor would have mandatory safe harbor employer contribution. That might be matching, that might be non-elective. Also, the employer contribution should be 100% vested. So would like stay here for a while, you could take a look of safe harbor employer contribution requirement. So that's 401k and a safe harbor 401k. This the both 401k and a safe harbor 401k had a Roth 401k feature, meaning you could also select, the employee could also select to contribute after-tax money. That's a good feature to have. So next we talk about a SEP and the simple plans. The SEP IA is it's most simple. It's not a qualified plan. It's simple to administer, simple to set up. A lot of banks could set it up. Brokerage company could set up. You don't need to file 5,500. However, I would like to emphasize here, because I do see people who don't pay attention to if you, business owner, select to use SEP, you also need to cover part-time employees and seasonal employees. The eligibility rule is very, many of those employees are also eligible. And when you sponsor a SEP IA, you also need to sponsor them. And the SEP IA, you have no loan provisions. You cannot borrow from the SEP IA. So good candidate for SEP. Next one, we talk about a saving incentive match plan for employees. That's simple. So the eligibility for simple is they have to have 100 or fewer employees with compensation of at least 5,000. There's no other employer sponsored plan. And all the employer contribution 100% vested. So the focus for the simple is employee. So basically that's a way for the employer to provide employee benefit with a simplified version of the retirement plan. So I want to emphasize here maximum contribution for the simple IA on the 2017. Its pre-tax employee contribution is up to 12,500. So that's a little bit less than the traditional 401k and safe harbor 401k. So a simple 100% of vested. Simple 401k, I would like to ignore here, not to cover this today because it's not popular this time. So lastly, we talk about the defined benefit plan. So that's the also could call pension. Right? If you work for government, work for the Navy, Army, for the old big corporations, you might have a pension, still have some pensions. So when you retired, you know how much you get monthly. That's a traditional defined benefit plan. Well, for small business, it's being popular with people who do not save much in the early years. Let's say you are successful business owners, however, you don't save much until age 45. So you have only 20 years to save instead of 40 years, 30 years. In order to catch up, profit sharing of 401k, the contribution might not be enough. So the big feature of defined benefit plan is you could contribute even $200,000 just make them for the defined benefit plan. So it's much bigger than the other qualified contribution plans. So that's big feature. Right now, there's a new. It's not listed here. There's plan design called it's defined benefit plan also. The name is cash balance plan. It's became right now it became more and more popular among small businesses and professionals. So it is defined benefit plan, but it's also very portable. It have some of the defined contribution plan feature. So hopefully we have some other time to cover details of cash balance plans, but not for today. So there's a defined benefit plan, advantage, disadvantage. So okay, so now we summarize for plans for owner-owning business. What's popular? What do they use? For owner-owning business, we typically 4 different plans. The SEP plan, the solo 401k, the profit sharing, and the DB plans. So let's say you just started, the business is not stable yet. You want a plan that's easy to set up, easy to manage. That's SEP. However, if we just mentioned before, SEP plan, you also need to cover the part-time employees and the seasonal workers. So it might be better case by case. So to use the profit sharing plan, because also profit sharing comparing to SEP profit sharing plan, you had a loan provision. You might also contribute possible more if you have part-time and seasonal workers. And, solo or simple or one person 401k, it's good choice too for owning business. Here difference between owning business, the one person 401k from a SEP, the major ones. First of all, you had a loan feature. You also had a Roth feature. You could also possibly put in more, even if you have same income than the SEP plans, because of the calculation is different. DB plan, again for owning business, if you start late, at your late 40s or 50s, you want to catch up to save enough for the retirement, the defined benefit plan might be a good choice. So we've been covered many different retirement plans. They all have different features and different costs. So this slide is summary. To select a right plan for your business, there's some considerations, major factors are important to you. Some maybe want to maximize the contributions. Some might want to minimize the cost. Also think of whether the business is stable or not. Also the employee eligibility requirement and some of the costs of administration. Also the complication, and you want simple to administrative, or you want more features. So there's a lot to consider when you choose the retirement plans. We recommend to consult a consultant expert. Okay. So I have to release. Tax laws are complex and subject to change. Morgan Stanley Smith Barney LLC, its affiliate, and Morgan Stanley Financial Advisors and private wealth advisors do not provide tax and legal advice and are not fiduciaries. And the ERISA, the IRS code, or otherwise, with respect to the services or activities described here, except as otherwise agreed to in writing by Morgan Stanley. Individuals are encouraged to consult their tax and legal advisors, A, before establishing a retirement plan or account, and B, regarding any potential tax, ERISA, and related consequences of any investment made under such plan or account. So that's the end of my webinar. Now the second session will be Q&A sessions. So Zihua will have to answer all the questions.
Thanks, Kai. I'd like to take a second to welcome Jiwa Liu from PenServe, who will be helping us out with the Q&A. She has a couple questions for Kai of her own, but I'd like to stall a minute or so here and give you all a chance to write in yourselves. I'd also like to remind you about the Handouts tab. I used to get a lot of questions from people about how to download the PowerPoint slides, but ever since I started pointing this out, that's gone down. So just open up the tab marked Handouts, and the file is right there. You'll see it's called Webinar June 21st PowerPoint. We don't aim to name these things cryptically. So in addition to that, we also have the Questions tab. That's where you can write in a question for Kai and Jiwa. Don't be shy. You're going to get a survey after this is over asking how you liked the webinar, and whenever someone says something like, I wish they would have touched on X, I always ask myself why they didn't just ask the question. You've got two experts here, so take advantage of them. So with all that out of the way, I'm going to hand things over to Jiwa, who has the first question.
I'm Jiwa. I'm an in-law actually from PenServe. So we usually focus on the plan design, pension consulting, and also the plan administration. So I have one question coming in. And this question is cash balance plan a defined benefit plan? Yes, the cash balance plan is a defined benefit plan. Compared to the traditional defined benefit plan, cash balance plan is a lot easier to understand. It looks like a 401k plan, so every participant has an account balance. When the participant terminate or retire, the participant can receive the vesting account balance. But at the same time, it's a defined benefit plan, so it's solely funded by the employer, and it can produce a much bigger maximum deductible contribution, especially to an owner. Let me give you an example. So supposedly it's a small business owner, age 52, with at least 270,000 eligible plan compensation for 2017. So he can set up a defined cash balance plan. So he or she will be able to receive at least 190,000 per year, assuming the owner going to retire at age 62. So as you can see, compared to 54,000 for the 401k profit sharing plan. In the cash balance plan, you will be able to allocate 190,000 into your account for 2017. Also, for some of the cash balance plan is not solely for retirement plan purpose. Sometimes we also design a cash balance plan for the business planning solution. So we have a client which is 3 partners, dentist office. So there are 2 partners in their early 40s. One older partner is in 60 this year. He is planning to retire at age 65. So those 2 partners are planning to buy out the older partner's share through these 5 years. So we design a cash balance plan for this older partner. So this older partner are benefiting in this cash balance plan. Those 2 young partners are carved out of the cash balance plan. So the payout, the installment for buying those shares, actually paying to the cash balance plan for the benefit of this older partner. So it's tax-free. The older partner doesn't need to pick it up as part of his income, as a taxable income. And when the older partner retire at age 65, he will be able to walk away $1 million up to $2 million, depends on the agreement between him and the other 2 partners. So when you're doing the business planning, especially for those partnership company, retirement plan can be also be one of the vehicle you can use for business planning. Here we also have a question is about the 401k submission issue. I think this is a very common question for a lot of small business owner. So when they set up the 401k profit sharing plan for the employee, they need to upload the 401k contribution to the employee's plan account timely. When is timely? So in the past, most of the small business plan sponsor rely on the IRS 7-day safe harbor rule. But actually, in the current years, this is not the case, because the 7-day safe harbor rule established by IRS is only recognized by IRS. So when the Department of Labor audit the plan, they will determine whether if it's possible to submit the contribution to the participant's account earlier, then Department of Labor would like the contribution to submit as soon as possible. So for example, when they audit the plan, they determine you can actually submit it in 1 to 3 business days, but you actually submit it in the 5th day all the time. Then those 401k contribution, it will be determined to be submitted late. So for those questions, for those issues, I always say working with your TPA, and then they can give you a better suggestion when will be, is better for your benefit. So do we have any other questions coming in?
I mean, it looks like either you guys explained everything perfectly or everyone is really shy because we don't have any. Do you have any more yourself? Or?
Yeah, actually I have, because my firm, we're working with a lot of small business owner, and there's a common question every year we have to, a lot of our clients ask is I'm a small business owner, I'm a Schedule C person. When I have to remit my own 401k contribution, because as an owner, you are different from your employee. Your employee's 401k contribution has been remitted every payroll. But with a Schedule C owner, you don't know what your income will be until the next year when your accountant preparing your tax return. So for example, for 2017, the small business owner, you have until the earlier of the filing of your 2017 tax return on April 15 of 2018 to remit your 401k contribution for 2017 year. So if your tax return is on extension and you have until October 15 of 2018 for 2017 401k. So compared to the regular W-2 employee, you actually have, 9.5 months if your tax return is on extension, or 3.5 months, or 3.5 months if you file on April 15th. So for the partner, if you are a LLP partnership company, and if you file as, K1 instead of S corporation, and then you usually have until March 15 of the next year or September 15 of next year to remit your 401k contribution. It depends on whether your tax return is on extension or not. So if your tax return is on extension, then you have, so for 2017, you have until September 15 of 2018 to remit your 2017 contribution. If you want to file a tax return by March 15 of 2018, then your 401k contribution for 2017 need to be uploaded to your account by March 15 of 2018. So those are the common questions every year when we get to the tax return season. We always receive from our clients say, okay, when should I, upload my 401k contribution? So those are the guidelines you can follow. I think I have basically covered almost most of it, yeah.
All right, well, we don't have any questions from the audience, so I guess that's a good enough time as any to bring things to a close. Don't forget, you'll be receiving a recording of today's webinar and the PowerPoint slides via email. And when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how to best provide you important information in a webinar format. Our next webinar, Understanding New Jersey Disability Insurance and How You Can Save, will take place this Wednesday, June 28th, and we'll go over how you can move from the state disability insurance plan to a private one and save money. So until next time, for Kai Chen and Jiwa Liu, this is Vinny Civitello thanking you for being with us this morning and wishing you a great day.